Hey everyone, this is Byron with Cannon Trading, here to talk a little bit about margins in a brief high-level overview. Before we get started, let me read the futures trading disclaimer. Trading futures and options involves a risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. Only risk capital should be used when trading futures or options. You must review customer account agreements prior to establishing an account, and investors could lose more than their initial investment. Past results are not necessarily indicative of future results. The risk of loss in trading can be substantial. Carefully consider the inherent risk of such an investment in light of your financial condition. Let me change my slider here. Here we go. So real quick about margins. Margin is essentially a dollar amount that's required to leverage an open, long, or short position in any given futures market. It can vary amongst markets based on volatility, liquidity, the contract size, etc. There are three different margin types. You've heard of initial margin, most likely, maintenance margin, and intraday margin. Initial margin is also known as exchange margin. Initial margin is required when you carry an open position in the first day of trading. Maintenance margin is required if you carry that same position into 2 or more days of trading. Intraday margin is only applicable when you trade during the day. And in most cases, intraday margin applies from session open, which is typically 5 p.m. Central Time, up until 15 minutes prior to session close, which is 3:45 Central Time the following day. Margins are determined mostly by the Exchange Clearinghouse and the FCMs and IBs. They do a lot of complex calculations, formulas, etc., to come up with these margin levels. They're typically 3 to 12% of a contract's notional value versus 50% of the notional value for equities. For instance, the E-mini S&P, the notional value is $50 times the S&P index. This snapshot I took today, June 23rd, price was around 44.11.5. So you take $50 times 44.11.5, you get 220,575 notional value. Current maintenance margin is 11,200 for the ES, so that is 5.1% margin rate. Intraday margins again apply typically, some firms I should say are only during the day session. For equities-based trading, that's New York time, 9:30 a.m. Eastern to 4 p.m. And some firms again allow intraday sessions from session open up until session close or 15 minutes prior. Simplify. Consider margin requirement funds frozen in the account while in an open, long, or short position and thus not available for trading. Should that position get close to or at the margin level, you should get out of the position or scale it down to stay within margin limits. Otherwise, the risk desk may come in and liquidate your position and charge a fee. If required margin is in excess of account equity, the position is again subject to liquidation by the risk desk. eFutures and Cannon Pro platforms, which are our proprietary platforms, both display excess margin. So those are your available funds for trading. Here's a quick snapshot. And you can see here in this current open position, we're up a few dollars. Overnight maintenance, 11,200. Overnight initial, 1232. And we have an excess margin of 48,770 in this demo account. So in summary, leverage affords one the opportunity to trade large dollar value commodities with less capital. Margins essentially limit a contract's risk exposure while in an open position. The trading account is collateral. One can potentially lose more than the account value due to evolving market conditions and quick changing volatility from unforeseen circumstances, catastrophic events, geopolitical events, etc. You know the like. So that being said, thanks for quickly viewing my margin brief overview, and you can visit us at cannontrading.com or myself, Byron, at cannontrading.com. My direct number, 310-858-6114. Thank you. Good trading and good living. Bye.